Okay,
Yes, sir.
so let's see what is this risk. So basic definition of risk is the downside potential of the actual results being adverse compared to the expected results. Here we are talking about financial risk. And in business, what we do is we invest money with the intention that we need to make a profit on a future date. And there are a lot of estimates which are made. We make forecasts, and based on that, we plan how much to be investing our money. Now, when we make a forecast, everything is uncertain. So therefore, even the results are going to be uncertain. But you have already invested the money. So with the expectation that you're going to get positive returns, you make the investment. This investment could be either in the form of equity or in the form of debt. Now, when you make an investment in the form of debt, then obviously you got to make a repayment. And if your results are not generated the way you had forecasted, then obviously you are going to have a problem in repaying your loan as well as the installments. So what happens in the case of equity? Is it cost-free? Is equity cost-free? Do you
No,
have
sir.
any
It is a
Yeah, go ahead.
yeah. Equity is not cost free. It is, I think, it's highly costly because we have to create returns for the equity holders, and that is usually the higher than the other debt or other instruments.
Yeah, that's true, because they are taking greater amount of the risk. And when you take any company which goes into bankruptcy, then the equity holders are last in the line of repayment in case there is any asset which is realized and the payments are to be made to all the creditors. So therefore, the equity holders have to be paid a higher return. But here, is it necessary that you have to pay a return to the equity holders?
No, sir. It is a risk.
You see, it is not compulsory.
Yeah.
Unlike in debt, where you are compulsorily required to make the payment, in equity, the payment it's not compulsory. So therefore, the management can always take a plea that this year is not profitable, so we will compensate you probably next year when the situation improves. But again, we are uncertain about the future. And that is what risk is all about. Now let's understand another thing about risk. You see, before you started your education, that is when you were a child, did you know about finance or marketing or operations? No, you did not know because you were a child at that time. Your knowledge was zero. But slowly as you gain more and more knowledge, then automatically what happens is the risk will reduce. Risk is something you do not know about. The risk is something which you are uncertain about. Not even know what the probable outcomes are going to be. It reflects a total lack of knowledge of what may happen. To give you an example, do you know when this COVID-19 is going to be, let's say, resolved? Does anybody have any idea when COVID-19 is going to be resolved?
So we cannot be
Hello?
sure about it.
Pardon?
No, sir, we cannot be sure of when it will end.
Yeah, because we don't have any information about it. If we had some, let us say you take the case of smallpox or TB or any other illness where there is some kind of research which is already done, then in that case, the risk, the cure is available. We know when it can be cured. But in this particular case, we have no idea. People are talking about it going up to the month of September. See, now look at the situation we are in. We had a lockdown up till yesterday for 21 days. The lockdown gets extended up to 3rd of May. And we do not know what's going to happen on 3rd of May. If the situation improves, we are still uncertain whether this can recur. In China, it has already recurred. I'm told that about 95 people, new cases of COVID have already come in. So this is what is going to impact the future. The businesses are uncertain what is going to happen. The economy is uncertain where it is headed. Everybody is making all random guesses. Today you see the stock market going up and down all over the place. People are just thinking, people are just trying to estimate what is likely to happen. But nobody is certain about what is going to happen. But let's take 1.5 years down the line. When there's a cure for COVID, then what happens? Since we have improved our knowledge regarding this illness or regarding this virus, automatically things will improve and we will be able to bring in greater amount of certainty. So the learning is, as you increase your knowledge, the uncertainty would reduce, the risk will reduce. So the only method by which you can reduce your risk is by improving your knowledge. Now, in finance, risk is a variable. It can be measured. It can also be compared. Like for instance, supposing you take two companies and you decide to invest in any one of the companies, why would you take that decision? Because you say that, okay, the returns that I'm going to get from this company are going to be greater or are going to satisfy me because of the risk associated with this company. So it is a measurable, it is measurable. But again, it is all an estimate. Risk is a function of not only the probability, but also it is potential intensity if it occurs. Has anybody heard about the turkey story? Have you heard about the turkey? The 1,000-day story about the turkey? Hello?
No,
No,
sir.
sir.
No, sir.
Okay, no, right? You know what happens during Christmas? What happens during Christmas? What is the favorite dish?
I think a
It's the
turkey.
turkey, right? So you see, what is actually done is every day the turkey is well fed. So the turkey believes that this is the normal, and so it believes that it can keep on eating, and every day it'll be fed. So it is happy in it and it's contented in its own way. Then just before Christmas, suddenly what happens is the turkey is converted into a dish and it is feasted on. So now what has happened here is that there was the belief that the every day would be the same. But what happened all of a sudden was that belief got shattered and it ended the life of the turkey. So anything which is very uncertain or anything which we don't have knowledge of, it has a great potential to destroy. It can be catastrophic in nature. Like for instance, you take this COVID-19 which happened. What happened to the stock markets because of this COVID-19? They all collapsed. Why did they collapse? Not because of anything else, but we didn't know what was hitting us. So this happens every 100 years. There is a pandemic every 100 years. And in economies will always go up and down. And there will be times when the magnitude of the risk that manifests itself will be so huge that mankind will not be prepared. To give you another example, you see, we all talk about terrorism, we all talk about terrorists, etc. But terrorists are limited, whereas if you take the natural calamities which happen, like a tsunami, or anything which nature involves itself, like for instance, even this COVID, the disaster is huge. It is catastrophic in nature. So now I would suggest that there are a couple of books which have been written by a person called Nassim Taleb. I don't know whether you've heard of him. Have you heard of something called the black swan? Hello? Have you heard of something called the black swan?
No, sir. No, sir.
Okay, anyway, I'll give you a list of books which have been written by a person called Nassim Taleb. And he gives you a great idea of what this risk is all about. And when you read his kind of books, then you start believing, or then you start wondering, where exactly is all this headed? And all the studies that we make, whether we talk about statistics, etc., we need to understand that statistics is limited in predicting risk. Okay. Now, take the case of any project which you prepare, a project report. What do? Where do you prepare it? You prepare it on Excel, correct? Now, in Excel, what you have is a beauty that you can just say the growth in your sales is going to be 10%, and then you can just drag it across and you will get the sales for the next 20 years. But is that possible? Because it is all linear in nature. But what we also need to understand is that nature is not linear, it is non-linear. And therefore, trying to predict risk and trying to calibrate and trying to study risk becomes more and more difficult. Now, as per his book, you all have heard of the bell curve, right? The bell curve, he says, is the biggest fraud on mankind. Now, whether it is right, whether it is wrong, that is another issue. But what we have to understand is statistics is only to be taken to the extent whether the data is reliable or not. Now, supposing you take 1,000 different data points and you analyze those data points, but the 1,001th data point that you have not taken into account is probably going to be the only point which is going to create the risk. So the data has to be reliable, and all the results that happen are based on what kind of data you have. The quality of the data is very important. Now, generally, risk is measured using the concept of standard deviation. You all must be knowing what is the standard deviation. It's part of statistics. And again, the moment you start using statistics in measuring risk, then the people who are managing risk, they tend to believe that, okay, so since I am now confident that 98% of the time I'm covered, so I'm taking only 2% risk. So then they start becoming complacent. But that 2% can become extremely risky. Now, this COVID, or for that matter, your 2007-8 crisis, or the earlier 2000 crisis, or the 1998 crisis, 1982 crisis, all these crises were all maybe the six standard deviation, six sigma or six standard deviation. Now, when you have six standard deviation, you cannot cover all the risks. So therefore, risk is always going to be existing. And we need to understand that as mankind, as humans, we are exposed to risk on a daily basis. From birth to death, we are exposed to risk. Whatever you try to do, you can only try to reduce the impact of risk, but risk can never be eliminated. Now, risk is the possibility of a loss and peril is the cause of the loss. Now, what it actually means is risk is only a possibility, but like for instance, fire. Fire is the peril, okay? Fire is the, but is it always going to happen that you're going to have fire? It's not necessary. So there is a risk in fire, but the fire is the cause of the loss. And what is a hazard? Hazard is something which is going to increase the probability of the peril. So for instance, suppose you hang next to, let's say, a furnace, then the oil tanker becomes the hazard for the risk which is going to manifest in the form of the peril, which is the furnace. So degree of information available determines the entity's perception of the expected value and the probability distribution. Now there is a concept of outliers. What are outliers? Normally, what we do when we take a when we do data analysis is we try to get the best curve, right? Best fit curve. Now, when we take the best fit curve and try to find the standard deviation, etc., there are many data points which don't fall under the distribution curve. Now, those data points cannot be ignored. Statistics, those data points which are lying on the outskirts, on the outside, they don't become a part of the normal curve. And then we tend to believe that, okay, we are covered to the extent of 98%. And those data points are not important. They are ignored. But the whole problem is, it could be those data points which can actually create the maximum amount of risk. So therefore, we cannot ignore any of the data points. And how much data points can you actually study? So therefore, studying risk has to have its own problems, okay? Risk is the possibility of something unpleasant happening or the chance of encountering loss or harm. Risk in the present context means the uncertainty of future cash flows. Like now we're talking about financial risk management. Now, we have different kinds of people who invest in the markets. You have traders, you have medium-term investors, and you have long-term investors. Whenever you take about long-term investors, there is something known as time value of money. There is a discounted cash flow. There is a present value. All this is dependent on the projected future cash flows. But when the future cash flows themselves are uncertain, then how can we predict what should be the price? So everything is only a guesstimate. There is no certainty about a value. Value is what you think you should be paying. And you pay a price, okay? The price should always be less than the value which you think you're going to get from the asset which you are acquiring. Assets generate future cash flows. You estimate what is going to be the future cash flows. And based on that estimation, you decide what should be the price which you're going to pay. But those future cash flows being uncertain themselves, the price which you pay today may not generate the return that you expect. And that is where your risk lies. Okay. Any questions that you have, you can ask me. We'll have an interactive session rather than holding it for the end. Because the subject is a little bit tricky, that a little bit of it is abstract, a little bit of it is going to be macro, a little bit is micro, as well as there are going to be concepts which are going to be thrown to you. Yes, please. Any questions you have so far?
Not right
Hello? Not right now. You're understanding what we are talking about? And you are able to see the presentation which I had given it to you. Given earlier.
Yes.
I'm using the same presentation. So now we talk about the risk manager. The risk manager's job is identification of the nature of risk. So there are different kinds of risk which we will see later. So he tries to identify the risk. Then he tries to manage the risk, and he looks at the cost of managing the risk. If the cost of managing is greater than the probable loss because of the risk, then he may just ignore the risk and not try to manage the risk. So there are different kinds of risks. So there's pure risks and speculative risks. These are the different classifications. Then there are acceptable risks and non-acceptable risks, and static and dynamic risks. So let's look at each one of them. So pure risks is where you have an exposure to property. Now here, the loss is actually the damage to some asset. There is a physical loss. This is a pure risk. Next is liability exposure. Now here, when you take insurance companies, etc., they have a liability, and that liability, if it incurs, and if it is going to be catastrophic in nature, then it is going to probably damage the company itself or the existence of the company. That becomes your liability exposure. life and health exposure, I think you should, I mean, I have less to speak on this because you already know about it. You have COVID telling you that life and health both are at problem today. So you better wear masks when you go out. You better wash your hands. These are the minimum things which you need to do. And everything is uncertain. They say that it is the virus is only transmitted through metal, etc. There are reports that it can also be airborne. Some say that the life is 3 hours. Some say it is 9 hours. It depends. So everything is uncertain. So be very, very careful. Financial exposure can be either a pure risk or a speculative risk. Now, when we say that when we say that it can be a pure risk or a speculative risk, one is where I know a possible consequence, and the other is where I say that I'm going to take advantage because I predict that going up in the future. Or I take a loan. Let us say I take a loan from the US and I deploy those funds in India. Then I'm taking advantage of the lower interest rate in the US as compared to India. But what we have to understand is I have got to repay the US loan in dollars. If tomorrow the rupee depreciates to a level beyond what I had anticipated, I end up paying more rupees per dollar. And in that kind of scenario, the situation could be such that I could even become bankrupt. Now, that is a speculative risk. Similarly, I buy something today with the belief that tomorrow the prices will go up and I'll be able to sell it and I can make a profit. But tomorrow, the prices actually fall. So that is a speculative risk. Now let's take the case of a pure risk. I invest in some building and with the hope that everything is going to be fine. I'm not insured for fire. And suddenly there is a fire, the building gets damaged. That's a pure risk, okay? So then second part is acceptable risk and non-acceptable risks. So acceptable risks are those kind of risks which the business is willing to take into its books, and non-acceptable risks are those which could be operational in nature, where I am not protected at all, and I go and take a position, where I said, okay, my exposure should be only 10 crores, but I go and take an exposure of 100 crores. Now that is not an acceptable risk, okay? Yeah. Now, we are further classifying it, business event risk. What is this business event risk? Why does it happen? It could happen because of collapse of markets. Now, when we say collapse of markets, this could happen because of various reasons. Like for instance, the government may tomorrow decide that all markets are going to be closed for the next 1 month. They're going to be closed for the next 2 months. We are uncertain what's going to happen. Now, so when there is uncertainty, markets collapse, political interference could be there. There is huge amount of risk involved in the markets in the sense that people do not know what's really going to happen. So that's a business event risk. Now, for instance, there could be a change in technology. There could be a change in the kind of products that people are going to consume. So that's a collapse of market. When we say here market, you'd look at it from a marketing angle. Your products itself can change. People may have change in tastes. Like I'll give you an example. Nestle comes out with this Maggi noodles, and there was a problem a couple of years back in 2015 or 16, where it was said that Maggi should be banned, etc. And for about 6 months, they had a problem. So that was a collapse of market for Maggi. Then currency convertibility risk. Now here what happens is the government may impose some kind of restriction where they say that the rupees cannot be freely convertible into dollars and vice versa, or the dollars cannot be converted. Now, there is going to be a huge change which is happening globally. Right now, the US dollar is considered to be the reserve currency of the world, but maybe in the next 2 to 3 years, there is going to be the dominance of the dollar is going to be probably taken over by some other currencies. Every 60, 70 years, there is always a change in the dominance of currencies. Earlier, it was the pound sterling. Then it is now the dollar. The dollar has been important since 1945, 46. So it's expected that probably in another couple of years, the dollar may lose its importance. We do not know. This is expected. Then there is disaster risk. Now, disaster risk, you know of disasters. It could be tsunami, it could be earthquake, it could be any kind of natural calamities also. Then legal risk. Now here, contracts need to be enforced. Contracts need to be understood. Contracts should be enforceable under law. That's one aspect. The other aspect is where contracts are enforceable, but the courts pass judgments against the very principle on which the contract has been devised, because it probably violates some other rule. Then you have regulatory risk. Government keeps changing regulations. We got 5 minutes left. Is that it? Hello? Nishita, is it only 5 minutes more?
Yes, so for the session, we only have 4 minutes left now.
Yeah.
And
Then do we have to, then we have to re-log in?
yes, I'll send you
Pardon?
the new link. I'll send you the new
Okay.
link.
Yeah, fine. Then the next is, we are talking about regulatory risk, where government changes policy, the RBI changes policies, then all those things can happen. Reputation risk. Couple of years, the Reliance Group, I'm talking about the Anil Dhirubhai Ambani Group, the ADAG Group, had a great reputation. But what is the reputation now? So obviously they have defaulted on their loans. So his reputation has taken a beating. So his credit rating has come down. His company's credit ratings have come down. And that obviously is going to impact any business plans that he's involved in. Shift in credit rating. As you are aware, interest rates are based on the credit rating of the borrower. When the credit rating of the borrower changes, let's say from a AAA to a AA or a triple B or a A or B or C, whatever it is, whenever there is a shift in credit rating, then automatically the interest rates go up. The interest rates on your borrowing go up. When interest rates on your borrowing go up, your liability, your exposure for repayment goes up, and that could impact your cash flows. Next we have is the taxation risk. Government keeps changing taxation policies. And when you have taxation policies being changed frequently, obviously they are going to impact the calculations on which you have forecasted your performance. War risk. I think we all understand war risk. I think Colonel is there. He understands war risk very comfortably. And he also can explain probably war risk better than I can explain. War is something where all the effort, all the economic activity is stopped, and it is shifted towards the borders to protect the nation or protect the country. And at that time, economic policies are thrown in the dustbin. So that can create a problem for the business. Then we have what is known as the inflation risk. We all know what is inflation, right? Inflation is where prices tomorrow are going to be greater than prices as of today. Now, why does inflation happen? Inflation can happen because there is too much of money Inflation can happen because there is a shortage of goods. So there are multiple reasons why inflation can happen. Economists only talk about inflation, but there is another aspect which also needs to be considered, and that is known as the deflation risk, which I have not put here because that is a part of explanation only. Deflation is where you can have the prices of the future going to be less than the prices today. So people postpone consumption. Now, this is going to be again a problem. Now, when we talk about inflationary circumstances, there is a problem. When we talk about recession, there is a problem. When there is deflation in the economy, there is a problem. So there is no such thing as an ideal situation. Risk will always be there in whichever state of the economy you are in. Next we have is the investment risk. The other thing is systems get outdated when you have hacking, all sorts of things happening, systems, IT. You ask the IT guys, they will say that no, our systems never fail, it's human error. But humans run the systems don't run the humans so far. But the moment you have artificial intelligence coming into play, I don't know what's going to happen, who's going to fail whom. Mark-to-market error. Let's say you bought a security for 100 rupees yesterday. Today, the value of the security is 120. So when you say that the value of the security that you have in hand is 120 rupees, you've actually marked to market. Now, supposing instead of 120, you make it as 150. This is again, this could be a clerical error. This could be a system error. Supposing you bought the shares of, let's say, TCS, and by chance the system takes the prices of Infosys. So those kind of system errors can happen. Model error, yeah, this is wonderful. All models are created under certain systems, under certain assumptions. Invariably, models are being used right, left, and center without understanding the assumptions under which the models were created. No models can ever be successful in a dynamic environment. Models fail. Models fail and problems are created. Models have to be dynamic in nature, but we tend to make models very structured, and because they are very structured, therefore there can be a lot of model errors creating huge risks for the organization. Programming error. I've come across programming error very often. You see, what happens is, let's take the banking industry. Bankers understand banking. Systems guys understand systems. The systems guy interacts with the banker. The programmer creates what he has understood from what the banker has told him. He creates the system. But there could be a programming error because the programmer has programmed it the way he understood what the banker told him. So this kind of a problem can happen, and that's what we call as a programming error, and this could lead to collapse of even a bank. There have been collapses of banks, or there have been shutdowns, or there have been banks have had to close down because of programming errors. Close down, not failure, but closed down for operations for a couple of days. Telecom failure, very common. Bandwidth drops. Then what happens? You have telecom failure. Okay, there's another thing which I need to share with you. We've had these spectrum allocation, which is what all these companies like Idea, Jio, Bharti Airtel, they all went and subscribed and they got spectrum and they are operating this 4G and 3G and 5G, whatever it is, all these Gs. And because of the spectrum position, some payments had to be made to the government, and the government made these payments. The Supreme Court stepped in, and they instructed that these telecom companies have to make payments immediately, etc. Now, because of which Idea Vodafone has a problem. They have to pay a huge amount of money. Then when Vodafone and Idea merged, there was a problem. There was a taxation problem. Now, the Idea Vodafone share is, I think, 4 rupees, 3 rupees, something. So obviously, there is a risk that the market prices are very low now. Bharti Airtel, or you take Idea Vodafone, or you take the other. I don't think there are any other telecom companies. Now, these the government cannot allow these telecom companies to fail. There has to be competition, and therefore, Idea, Vodafone, they may not close down, right? So it's a good option for people who are looking at investing in the markets. I don't know what's going to happen. I'm uncertain about it, but yes, Idea Vodafone. If you're willing to lose money, and you say that, okay, it's 4 rupees, I'm going to buy 1,000 shares, I'm willing to lose 4,000, fine, it's a good opportunity to invest in Idea Vodafone. But I don't know what's going to happen. Nobody knows what's going to happen. Nobody can predict exactly what's going to happen tomorrow. Nobody can predict what's going to happen the next second. So predictions are always subject to a lot of doubt. Now, there's a repetition of what's going to happen. Interest rate risk, I'm not explaining. Exchange risk. This is basically exchange rate risk. Currencies change in values, and your exposures change in values, and this create problem. I've explained to you liquidity risk. I've not explained default risk. There's always a confusion between default risk and credit risk. Default risk occurs after the loan is granted, where the company defaults to make the payment. Credit risk is where the credit rating of the company drops. And because of the drop in the credit rating, therefore, the cost of borrowing increases. Now, internal business risk is basically connected with your business. Whatever your business is exposed to, whatever business risks are associated with your business, like your industry risk, like telecom sector industry, or cement sector, infrastructure, whichever industry, that is internal business risk. External business risk is your environment. You could have policies of environment, or you could have what you would call it as general economic policies. Financial risk, everybody understand, it's all in finance, money terms, currency terms. Events of God, yes. The events of God can never be predicted. And they are the only risks, which cannot be controlled. And they are the ones which are always catastrophic in nature. All the other risks will not be so large in magnitude as events of God. Market risk explained.
Sir.
Yeah.
Sir, the automobile sector risk was which type of risk?
Automobile sector is an external business risk now. Because people, you see, it's an internal as well as external. I'll tell you now, it's a very good question that you asked me. You see, there is a video of Mr. Damani, Ramesh Damani, from 10 lakhs to 100 crores, okay? You can see it on YouTube.
Yes.
He talks
Yes,
about probable businesses in the future. What he says is, okay, now to explain it to you, since you talked about automobile sector. You see, with these aggregators coming in, the question is, do you really need to own a car? If you don't need to own a car, then do you need to have a parking space? Then the third question which comes in is, Tesla and other companies are going to use artificial intelligence to drive you around. Then in that case, you just ring up, you get a car, it'll be driven by some robot, some system. Software will drive that, it'll take you, pick you up, drop you somewhere else, you make the payment, that car goes off. So there's no the number of vehicles which are going to be on the roads are going to come down. Pollution is going to come down, and things are going to improve. Now this is probably 5 years, 10 years down the line. We do not know. So automobile sector, a very risky sector. That's what I feel. I don't know, but it all depends on how long you plan to be invested in the automobile sector. Automobile sector is, when do you buy an automobile? You buy an automobile when you need it. With the metro coming in Pune, with probably all these Uber and Ola and other aggregators scaling up, with more artificial intelligence cars coming in, battery operated cars coming in, where does this industry go? It's a question mark. They will survive, but they will not be doing as well as they were doing earlier. Ownership of cars may not be a necessity. Similarly, ownership of accommodation may not be a necessity. You may have rental accommodation. So all these things are changing, and one has to keep this in mind when you look at the future. So there is this beautiful YouTube video of Ramesh Damani. I don't know whether you've heard of Ramesh Damani. He's a good investor in the stock exchange. I think he is also a director of BSE or something.
DMart.
So when you look at his...
I said DMart owner.
Hello?
DMart owner.
Not DMart. No, DMart owner is Rameshwar Damani. This is Ramesh Damani. Ramesh Damani, and you will find a YouTube video which says 10 lakhs to 100 crores, and he gives you all the what he thinks as the likely businesses of the future.
Okay.
So you can have a look at it, and then probably sometime we can even talk about it. I have no problem in talking about it. Okay. Next is personal risk. You can always have good people leaving you, and that could create a problem. Management. There's management, good management can leave you, and they are always at a premium. So you can't buy management at a discount. Human beings need to be priced properly, and no human being will ever accept that he's priced properly. You as an employee will say you are underpaid. The management as the owners will say you are overpaid. So there will always be a conflict, and there is not going to be ever an end to this conflict. Environmental risk, we are going through it presently. Just look at this COVID-19. It is nature recovering whatever has been destroyed by mankind. Nature is probably recovering its lost space. On the road, you find giraffes, you find bears, you find all these animals, which otherwise you could never find because of the number of vehicles which were you using. Human beings tended to destroy nature, and nature is now rewarding you by its own ways. It's got its own methods. That's why these events of God are always extremely catastrophic in nature for human beings. But for nature, it is something which is absolutely a must. Nature will never lose to you. However intelligent human beings can be, they can never replace nature, or they can never overtake the knowledge of nature. Nature only allows you to learn what it wants you to learn. Human beings have got huge egos, and that is a problem. We are not even a small speck of dust in this global, what you would call it, universe. Okay. Anyway, coming back, then there is production risk. You overproduce, you underproduce. This is another problem. Okay, now we come to, yeah, we got 5 minutes, so you can have some discussion on this. If you is managing the risk, we can take it up later also. Yeah. Any questions you have regarding your assignments or even those case studies or anything of that sort, you can always ask me now.
I have a question for you, sir.
Yeah.
So I'm Colonel Manoj. I just wanted to know, what is your perception of why the Anil Dhirubhai Ambani group flopped majorly everywhere?
Okay. You see, Anil Ambani is basically a finance person. And even when Dhirubhai was alive, he used to tell, he was very clear that Anil should only take care of the finances and Mukesh Bhai should only take care of the operations. Mukesh Ambani is excellent in implementation of policies and guidelines, etc. Anil Ambani overstretched himself. If you take the Reliance Power, and he priced the share at 450 rupees per share. Those were the days when everybody said markets are great, nothing is going to ever happen, markets are never going to collapse, and everything was very, very positive, everybody was optimistic, etc. He had only a piece of paper which awarded him a contract for setting up a power plant somewhere in UP, I forget the name. Based on that, he took money. Then he started diversifying those funds into other areas of his business. He is heavily leveraged. He has never been a good implementer or an executor of plans. He fell out with some good people like Uday Kotak. When he actually when the Ambani group split up between Mukesh Bhai and Anil Ambani, Uday Kotak was actually with Anil Ambani, but Anil Ambani fell off with Uday Kotak and he lost a very good friend. So these are some of the things which probably led. He's a very poor executioner, and if you are a poor executioner, you should not get into industry. You should be only into financing. You could have run a bank for all you care, but you can't run an organization which is into, say, infrastructure or which is into power generation, which requires huge operational skills. See, that was a problem. That's what I guess. I mean, I can't tell you everything over the thing. It can only be discussed over one-to-one. Do you agree? Yes, Colonel?
I agree with your assessment, sir. Perfectly.
Yeah. Yeah, but then if further details can only be discussed personally, not over a public forum.
Yeah, absolutely. What you said as far as finances are concerned, sir, is perfectly, on the head, because Reliance ran their mutual funds very well.
Yes.
Which recently was taken over by Nippon.
Correct.
And they sold it for a huge profit.
Yes.
Everything else that Anil Ambani touched, including telecom, their Pipavav dockyard, and everything else is flopped. Probably, as you correctly assessed, it was more of a implementation failure.
True. And the other thing is, even this telecom which he got, the Geo Telecom, Reliance Telecom, he got, Reliance Communications as he called it, he was never interested in it. He got it and he actually didn't want it as a part of the separation, But, well, he got it and he had to take it. And then he ensured that it collapsed or it died its natural death. It's unfortunate. Yes, any other questions that you have? Okay, just regarding your assignment and regarding the case studies. You see, the case studies will give you a better insight. These are case studies which are all available on the net. So you can download it, go through it. You can see the paraphrased version. You can see the longer version, whatever it is. It will give you a better idea of risk and why these companies failed. What were the problems which happened? You will also come across new terminologies which you probably will not understand otherwise. There is a subject called financial. Pardon?
Sorry, less than a minute left, sir.
Yeah. There is. I saw that. There is something called financial engineering. And there are lots of new products which have come in, which have created all these problems for all these companies.